Welcome to Five Things to Know About Washington's 2025 Tax Changes. In today's video, Grant and I are going to cover what the changes are, who this affects, and strategies that you can use that could make all of the difference. We focus here at Altera on helping you use your wealth to create a life that you love. And a big part of that is helping to understand all the frustration and addressing the frustration, confusion, complexity that taxes can bring. So that's going to be our focus here today. So Grant, why don't we start with what we're going to cover and why?
Well, Josh, we're going to cover what's changed in Washington estate and capital gains taxes, all of which has happened this year. There's been some big changes, and really go through what to consider if you're in some of these, what we've found to be the three top common situations our clients find themselves in. People that are thinking about selling a business, planning for creating harmony for the future of their family's legacy, and people that are actually nearing retirement or already in retirement, they're also affected too, which is comes as a surprise to many that we talk to. So let's move on to the next slide here and talk about, why does this matter now? Well, one is these new laws, they're already in effect. This stuff went into effect in July of 2025. And we've found in doing a lot of our work here at Altera that this is significantly impacting families, especially ones that we come into contact with that don't have a coordinated plan yet. So, depending on your situation, your exposure and or opportunity with the new changes really depend on your specific situation. And I want to kick us off by talking about the estate tax changes first. So Washington's estate tax exemption increased to 3 million in July. But at the same time, the top tax rate jumped from 20 to 35%. So 2.19 to 3 million, that's a gain for some folks, but that jump from 20 to 35 is a pretty big cut for others. We're seeing some lower taxes, some people with smaller estates, but then potentially a lot higher taxes for larger ones.
So, and we can help you place yourself if you're watching this. We can help you place yourself kind of in a bracket here. So we're not going to cover step by step each one of these. You can pause the video here and kind of place yourself. But what we're noticing is that some estate values actually had their tax bills go down. So if you're in a $5 million total estate value here in the state of Washington, in 2024 your taxes were about 360,000. Those actually went down to about 250,000 in that estate range. So your tax bill went down. What we're noticing is that the break-even period, what's kind of that threshold, is about $9 million. And so, for example, if you had a $10 million estate, your 2024 tax was about 1.26 million, went up to 1.33, so slightly higher. But then as you climb above that, you're talking about significantly higher tax bills that if you did nothing would pass right down to your heirs, cut a little bit more out of what passes to the people and the causes that you care about. So at 20 million, we estimate you're paying about $1.5 million more in estate tax just to the state of Washington. At 50 million, that's creeping up to about 6 million, which is a pretty significant jump. So whether or not you're going to be paying higher taxes is really going to depend on where you fall in this bracket. And of course, it takes consulting with your team and so on to really accurately assess any of this. So with that, we can also then take a look at some of the changes in Washington State's capital gain tax. So it's not just the estate tax that changed, it's the capital gain tax that changed. So a handful of years ago, we saw that Washington introduced the 7% capital gain tax above a certain exemption threshold. What they changed this time around was they added a new higher tax rate at gains above $1 million. So let's take a quick look through this. So right now, as of this year, your first $278,000 of gain is exempt. Then the next $1 million of gain would be taxed at 7%. The tier that got added is if your taxable gains exceed $1 million, well, now you're close to 10% on that. Grant, you mentioned this right at the start that the estate tax or some of these tax changes went into force in July. The capital gain tax is retroactive to the beginning of this year. So if you sold a bunch of assets earlier in the year, this is actually retroactive back to the start of the year. And there's a handful of excluded assets. We don't have time to go into all of the nuts and bolts of exactly what's excluded, all the various deductions. This is why it's really important to consult with your tax, financial, legal team about these various things. Oh. got a little excited there and jumped forward. Um, so yes, like I mentioned briefly here, there's a handful of assets that are excluded. And we can cover. We'll talk more about that later. But let's take a quick look at an example of the capital gain tax in kind of a case study here. So if you are planning to sell a business here in Washington State that's not otherwise exempt, we'll talk a little bit more about that here in just a moment. If you sold that business for $10 million, under the new rate, you could be paying close to $1 million, about $933,000 in capital gain tax. And then if you add that to the federal tax rate, that combines to about a third of that gain. If this full sale was capital gain taxable, that's about a third of your proceeds just lost to capital gain tax. That's before any of the estate tax implications. That's before some of the other
Mm.
federal income tax potential things. So this is why for people that are focused on making the most of their wealth, taxes are one of these massively confusing, frustrating, seemingly convoluted elements that just must be addressed very specifically. So, looking at what potentially could be a pretty big tax hit, Grant, why don't we shift to a couple things that people that might be frustrated with the potential here, what can you do about that?
Yeah, and frustration is kind of the word and the feeling that we hear a lot when we're talking with various business owners because they're like that. Just in that example of just 10 million in a business sale, which many business sales far exceed that in gains. That's almost $1 million of tax that didn't exist a few years ago.
Hmm.
So it can be very frustrating and get in the way of what you're trying to do with your business and your wealth that you've worked hard to build. So what can you do? So there's a lot of different things. Of course, it takes a coordinated plan, but the one we want to point out on the top is see if you qualify as a qualified family-owned business. We're going to cover more on that here in a minute. But other tactics to use would be as part of your sales strategy, as we like to call it, is what about installment sales? Installment sales can be structured strategically. They have their pros and cons to smooth out income, which also smooths out your tax bill and can actually reduce the overall burden. Charitable remainder trusts, these can be set up if you're charitably inclined to defer massive amounts of gains, impact causes you care about, while also creating income for your family. So that can be a really valuable tool to partition as part of the strategy. And then there's things like intentionally defective trusts. These will help move part of the business and or assets outside the estate to help drive down some of these taxes over time. Can be very, very effective. And we see some owners even just saying, you know what, I'm going to try to move my domicile to another state and set up shop, get permanent residence elsewhere to get completely around the Washington tax. That's something to consult your legal team about for sure, just to make sure that you're not getting in line of evading taxes or something like that. Um, Last, though, is on your workup to this exit event, make the most out of your final income years by funding high limit retirement plans. Remember, high limit some of these retirement plans aren't included in all of these taxes we talked about, like the capital gain tax, but you could be saving large amounts of tax on the way up to retirement. We've seen in design plans in the $400,000 to $500,000 tax deductible contribution range. That's big impact. And plans like that can really help push that burden down that you would be facing now and help get those assets out of the way.
This is also why a comprehensive look at your planning is so important, even when it comes to taxes. Taxes,
Hmm.
even in itself, isn't one monolithic topic. So we could say, well, if the goal, yes, certainly is to manage and reduce capital gain tax, well, why wouldn't we want to take that approach across the board? So this last bullet point is a great example of the type of observation we end up making when somebody says, hey, I want to reduce my fill in the blank type of a tax. And we say, great. What if there's ways to reduce other types of taxes as well if you own a business or have these things at your disposal? Grant, you mentioned this just a moment ago, the idea of qualifying as a or seeing if you qualify as a qualified family-owned business. Again, we do not have time to cover all of the nuts and bolts of this, but you're welcome to pause the video here, take a look at these various criteria for in Washington State, what exempts your business from the estate tax. And then again, the qualifications, of course, because tax laws are wildly complicated. The capital gains exemption criteria for a qualified family-owned business is different to be exempt from the capital gain tax than it is for the estate tax. So again, you can pause here, take a look at this, and then as with all of this, you need to carefully look at this with your tax, legal, financial team to see if you qualify for this. The last thing in the world you want to do is assume you qualify and then find out when it's way too late that you did not qualify. That's a nightmare. So we definitely don't want that for you. So when we talk about strategies that you could consider to mitigate this tax impact if you own a business, hopefully some of these things help. What happens, what we experience with a lot of our clients is now that they are out of their business and they're on to the next stage of things, we would say they're in this retired or nearly retired category. So if you're thinking about selling your business or you have just sold your business and now you're thinking, well, how are these tax laws going to impact me now that I'm kind of out of that phase and into the next phase? There's a handful of things to consider here if you're retired or nearly retired. So Grant, why don't you take us for a quick kind of spin through some of these things?
Yeah, and this is another area that we find with folks that don't think they're wealthy. That they kind of, well, I'm not
Yes.
wealthy. That doesn't really impact me. But you'd be surprised how quickly many folks cross that $3 million estate tax threshold and they're not really thinking about it. They hear about the big federal estate tax and they say, no, I'm not including that. But a lot of people are caught in Washington's crosshairs here when it comes to the estate tax. You add in your IRAs, values your homes, the death benefits on your life insurance, and you'll push through that threshold pretty quick. So there's a couple things that we want to bring to people's attentions. Again, these are various tools that need to be part of a well-designed strategy, like Josh was saying here a minute ago. But if you're simple things like if you're married, making sure there's proper provisions in your wills to take advantage of both of these $3 million Washington estate tax exemptions. And then it's about creating intentional tax management into your retirement income strategy. So strategies like Roth conversions, tax loss harvesting help optimize taxes for you, but they're also teeing up how the next generation is going to receive that wealth. And so when you compound that over time, it can have big impact. And then there's life insurance strategies that help shelter funds completely from taxes that also can help kind of be a double play and help provide provisions for long-term care needs that may be a threat to spending down your assets before you and your spouse have been able to use them. These things can easily be utilized to help with that, as well as transferring wealth to the next generation. So, last, we want to point out you got to plan gifts carefully. For example, we typically recommend start small while you're younger and then increase as the years go by. Again, the fear that occupies a lot of our clients' minds is, am I going to give away too much too soon? And that's just not a comfortable place to be. But with a good plan, you can map out a strategy that really dials us in and keeps money in the family and out of the tax man's hands.
Yeah, this is why, again, we sound like a broken record probably, but why a comprehensive plan is so important. You need a team, a cohesive team, whether or not everybody works in the same firm exactly, but you need coordination between your financial, tax, legal, so that you're looking at the big picture, and looking both at the combination of what do you need for your life, and then what is free if you want to pass it on while you're alive to the people and causes you care about. So let's move more into that camp. What if your primary focus is around maximizing what you're going to pass on to the people that you care most about, people in your family? So Grant, take us through a few of these strategies and how I might be thinking about these if this is me.
Well, yeah. So families that are in that retirement stage, they have that covered. They're thinking about how am I going to write my story from here? What's the story of the family going to look like? They're looking at this like, what is this? How's this going to impact our family? Well, hitting the numbers for a moment, estates under $7 million are probably going to benefit from this tax legislation change, and then over 9 million, maybe not so much, and it's going to get worse the higher you go from there. But regardless of their level of wealth, it doesn't matter which client we work with, the super high net worth to what you'd say is all the rest of everyone. Everyone still has that innate need to know, what's my number? What's the amount that I'm going to be okay, regardless of the future recessions that will come and the ups and downs in the economy, that I know without degree, I have a high degree of certainty and clarity that I'm going to have enough income to live the rest of my life comfortably and never become a burden on my family. So we say we start there. regardless of the legacy go, we got to make sure we know that before we move on to figuring out how to deal with the estate tax issue and gifting and things like that. Um, once you have that, you'll have that confidence to move forward. So from there, then we know, okay, what can we, well, how much do we need access to? And where can we afford to give up some access? Because we typically have to give up some access to some funds via gifting and or trusts, strategies like gifting to irrevocable life insurance trusts, things like that. You're going to give up a little bit of access today to have a huge impact on the family wealth transfer. And strategies like irrevocable life insurance trusts have become more important than ever now with these rises because life insurance has a unique quality to it. It avoids capital gains tax. Well, we just talked about capital gains tax going up in Washington. Well, there's also a federal one. So that's two tax right there that it gets rid of. When it's inside a trust structure like this, now it's also avoiding estate tax and it's not paying income tax either. So it's a very powerful combo to have for someone who's focusing on how do I move my wealth best to the next generation and provide for some of these problems like taxes. And again, Josh, you mentioned this minute ago on the last slide. There's a lot of good ideas here, different strategies from Roth conversions to trusts and things like we're talking about a, a lot these collection of good ideas need to be crafted into a unique plan strategy unique to your situation to have the desired impact, and so I can't stress that enough. So when we're thinking about this, we have rising taxes, which usually means rising complexity, and that is true. So if you're sitting here listening to some of this and you're feeling maybe more uncertain or confused than when we started this, you're not alone. We see confusion about tax rules, pressure to act, and a fear of overpaying on taxes. You don't have the right strategy. It's real. There's a myriad and stacks of taxes here, and it is complex. And that's really where a plan comes in. Help provide that clarity of how to coordinate your assets and along with your desires for your goals and what you want for your family, built around and designed to address the problems that you're facing.
And I would say that's one of the reasons that for us, we think one plan plus one team equals that clarity and confidence. Uh, Now, one plan, meaning all of the different facets of your life are talking to each other and working together. One team, again, whether or not your attorney team, your legal team, your CPA, tax team, your financial and wealth managers all actually are in the same firm. They should function like one team. When we work to build a plan like this, that's why we coordinate with all these different moving parts. You can't have a fragmented approach and expect clarity, simplicity, and the certainty that you're looking for to move forward with strategies that make a big impact if I don't totally understand what are the trade-offs. One of my favorite quotes that applies to something like this is there's no such thing as solutions, there's just trade-offs. What you're doing is you're giving up something to gain something else. What I have to make sure is that I can offset those with my plan. Your plan is what brings all of that together. It's what can lead to less tax. It's what can lead reduce kind of conflict in information between or advice between different parties, and bring that together truly in one unified approach. Um, so hopefully that's demonstrated in the impacts that you can have when you look at these various strategies, even in changing tax law landscapes, and hope you help you move forward with confidence, understanding the impacts of all of these across your plan. So we hope this has been helpful to you. We've put a couple of QR codes up here, as well as a couple of links here for more archived insights from our team. We've written on our insights blog. We have topics across the spectrum from how much do I keep in emergency reserve to maximizing the impact of legacy and estate planning, like we've really more focused on here. If you find yourself wanting to figure out how this could fit for you, you're welcome to scan that second QR code, have an initial discussion with us to find out if we're the fit for the needs that you have. But regardless, we hope this has been helpful to you and would like to thank you for joining us, and we'll look forward to seeing you next time.